Dennis, we're in your great hands. Thank you.
Well, thank you so much, President Cannon. It's my pleasure to lead a chat with Raphael Bostic, and to introduce Raphael, I'm just going to do a sort of lightning round introduction because I think you're familiar with Raphael. This is his fourth appearance in front of the Atlanta Rotary. And his background is a Harvard undergraduate, Stanford PhD in economics, Federal Reserve staff in Washington. I think he was seconded briefly to the Treasury Department, University of Southern California professor, where he devoted himself a great deal to housing economic questions. And then in the Obama administration in housing policy, back to University of Southern California. And then in 2017, June of 2017, Raphael came to Atlanta to be the 15th president of the Federal Reserve Bank of Atlanta. So let's bring Raphael to the stage. Here he is. Hi, Raphael.
Hey, Dennis, how are you doing?
I'm doing well. There's a lot to talk about, so let's get into it. I'll start with an apology. Last January, I just didn't ask the right question. I didn't ask if we were going to have an epidemic, a 35% drop in GDP growth in the second quarter, a 33% recovery in the third quarter, and according to your GDP now, about 9% growth in the fourth quarter. All that is sort of the background of where we are today. So my first question to you really is, where is the economy in real time? Where is it today? How is it performing?
Well, I actually, first of all, thank you for doing this, Dennis. I really like this format better than just giving a speech. And so I really appreciate you being willing to do this. You summarized 2020 very well at a high level. Incredibly tumultuous, a lot of unexpected events, and an economy that kind of got hit really hard in response to the public health challenge, but then recovered, I think, stronger than what most people expected. Where we are right now, I think we're at a crossroads, right? We have a public health problem. We've got to get that solved, and the rollout of the vaccine, the presence of a vaccine and its rollout is a pathway to get that solution. But we are still in the midst of a lot of the disruption associated with the crisis. And so the economy is behind where it was if we had not had the virus. And we are still needing to offer relief to many segments of the economy that are still very much at risk of falling apart. So it's on the one hand, on the other hand, on the one hand, the long to medium term looks pretty positive, but in the immediate term, we have a pretty serious challenge that we've got to face. We've got to stay diligent and mindful to make sure that we're aware of where there's weakness, and we try to provide relief to give those segments of the economy a bridge to sort of the post-pandemic era.
I know you and your colleagues focus greatly on the statutory objectives of the Fed: employment and inflation, price stability. Where do those stand at the moment?
Well, from an employment perspective, we've got a ways to go. So pre-pandemic employment, the unemployment rate was about 3.7 to 3.8%, historic by just about any standard. The unemployment rate went up to 15 and even greater than that percent. And now we're in the 6 to 6.5% range, depending on who you talk to and what measure you use. That's a lot of recovery, but at the same time, we're still about 10 million jobs short of where we were pre-pandemic. So there's a lot of work that still needs to be done on the employment side. In terms of inflation, this is a hard one, because what we've seen through 2020 is families and businesses really changing the mix of goods that they purchase and they demand. And that's led to a lot of volatility in our prices. And so while inflation comes in a little less than our 2% target, that aggregate number sort of masks a lot of unexpected and unusual volatility in how prices proceed. So I think it's actually very hard to know what's happening in inflation right now because of that volatility. I'm hopeful that as we get through the first part of this year, some of that smooths out so we get clearer signals about what's happening in terms of prices.
I have heard a lot of talk from close observers that we should be paying attention as well to asset price inflation, that there's consumer price inflation, but then there are asset prices, which would be share prices or real estate prices, that kind of thing. Do you agree with that? And what's your view of the current state of asset price inflation?
So first of all, I think, on some level, you have to look at everything. For me, the Main Street sort of fundamental baseline producing of goods and that basic consumption, that's my frontline focus. But the asset markets, the Wall Street and the like, they do provide signals of where the economy is. So we have to pay attention to that. What I will say is, one thing that has happened through the course of this pandemic is that certain segments and certain sectors of the economy have been hit a lot harder. And many of them do not have the same sort of exposure or presence in asset markets. And so, a lot of the bigger firms in the S&P 500, for example, you think about Amazon or Netflix or Google, they've actually done quite well because of the way that the economy has evolved. And so that strength is going to reflect itself in asset prices. But at the same time, I think it's important that we don't use that as the sole metric. There's a lot of pain that's gone on. We're short about 10 million jobs. We've got small businesses that are under a lot of stress. We've got families that are really very much reliant on the relief packages that have come out of Washington. And so it really is a very uneven type of experience. And we've got to make sure that our sites see that whole spectrum of pandemic experience and recovery.
I've heard you say, and I've heard Chairman Jay Powell say, that the forecast is really a function of the course of the pandemic, and that you have to really have some scenario in mind in terms of how the COVID-19 situation evolves in order to make an economic forecast. And I'm curious, I doubt that you took a course in epidemiology when you were getting your PhD. How do you do that? How do you first make a call on the pandemic and then make a call on the economy?
Well, that's very hard. One thing I've said in a number of settings is that I've had to do a crash course in epidemiology and really learn how to hear what public health officials are saying, and then trying to translate that into what I'm seeing on the ground. As I said at the very beginning, one of the things I always say in talking about today's economy is that at heart, it's a public health crisis first. All the economic fallout has been a function of how we've responded to the public health crisis. And until that gets settled, until we don't have to have the same sorts of stringent responses to prevent the spread of the virus, the economy is going to play out in a slower way than we might have expected. Now, you raised a real important point here, which is that making a forecast about this year is really at its heart making a forecast about how well the vaccine is going to penetrate into the population, so that we're at a place where we don't have to be so cautious in how we do a lot of our economic activity, and a lot of the fear associated with the possibility of contracting the virus by doing basic economic activity goes away. So we're monitoring that. I talk to a lot of folks, and we hear lots of different perspectives. My expectation in our models right now is that sometime by the summertime or in the summertime, we will get to a level of penetration of the vaccine that will allow the economy to really start to pick up. People, I think, are eager to re-engage in the economy. And once they feel comfortable doing that, I think they're going to do that pretty robustly. But at the same time, we've never really done anything like this in many, many years. This, like getting a nation vaccinated with a new product that was developed extremely quickly in a setting where social distancing and the like is at its heart. an essential element of this. There's a lot of logistics that's going on here, and we're trying to manage and monitor just how that is going. And I'm hopeful that, I know everyone has read about hiccups that have gone on. I'm hopeful that through these hiccups, we're actually learning what things we need to do better so that collectively, come February, even into March, we've got this system down and we can get lots of people vaccinated in very short order.
So you've touched on your outlook. I take it, and I've heard you say this as well, that we're not out of the woods yet. That's a summary statement. And that the next few months, I gather from your thinking, the next few months could be pretty rocky, but then will be followed by a better situation. That's your base case for the year. What's your outlook for the medium term? Are we going to see a full recovery, or is this more of a slow slog to get back to where we were in January of last year?
Well, Dennis, I think that depends on a lot of factors. My baseline outlook right now is that the recovery is going to be robust, but I have to really make this point. We are learning about what it is to live in a pandemic every day. And when we did surveys of businesses in April at the very beginning, what they told us was they thought that many of the respondents thought we would be done with the pandemic by September. October at the outside. It is now January, so we are actually having to recalibrate sort of what the horizon of this looks like and how much further we have to go before we're on the other side. So when I look at where we are today, we just saw a relief package passed. Many of those provisions are going to March. That has embedded in it an assumption about how much longer relief is going to be needed and how effectively we're going to get the vaccine into the population. What will be very important is for all of us to monitor what's going on. And then when we get to March, hopefully before that, we'll have a sense of whether additional relief is needed. And then that relief has to be delivered. Because if that does not happen, then a lot of the risk that is presently in the economy may actually be realized and create more permanent damage. I think about all these relief packages as really trying to make the damage that's going on right now temporary, so that when we get to a vaccinated population, all those businesses that are kind of just figuring out how to hang on, they can turn around and turn things on very robustly. And if that happens, then the economy can really grow in a very strong way. But that is conditional on us keeping them around through the entire duration of this pandemic, and the relief that has been offered and the presence of relief will be quite important for that to happen.
The Federal Reserve and the Federal Open Market Committee that sets monetary policy moved very rapidly in March, and I think you should be applauded for that, and brought interest rates back down, at least the policy rate, to what is effectively zero. Can't really go any lower. And certainly the noise or the signaling that comes out of Federal Reserve officials' comments is that we're going to see that interest rate environment for quite some time. So let's do a little inside baseball talk here. A few months ago, the Federal Reserve revised its strategic framework. Can you walk everyone through what changes were made in the broad framework for setting policy?
Well, first, let me just step back and say, about 10 years ago, leaders at the Federal Reserve decided that there was real value in us making a statement, articulating our philosophies and viewpoints on what a longer term strategy and objective should be. And Dennis, you were part of that conversation and helped really ratify that first statement. Well, even before the pandemic started, we started a review of that statement. It had been 6 or 7 years since that had been issued. And as with any policy document, it's important to revisit these things. So we had a series of conversations internal to the committee, but we also did a listening session around the country where we heard from business leaders and from community groups about what they felt was going on in terms of both employment and inflation, so that we could have that inform what the next iteration of this policy would be. In the summertime, as you noted, we came out with a new statement. I think there are a couple of things that are noteworthy in that statement that really reflect significant changes. The first is a recognition that in the current economic environment, inflation and interest rates are likely to be lower than they had been before. And there are a number of reasons for this, but this has been a trend that's happened starting in the 1990s. As a long-term trend where just the baseline upward pressure on inflation has declined, and there's a large academic group of scholars that is working to try to unpack all of that stuff. And so if you're going to have an environment where interest rates are going to be lower, then that means we have to really be very present with all the other tools that we have. And so one statement that we have really acknowledges that part. There's a second part of the statement that I think was also quite important, really around employment and our employment mandate, which was that employment we're going to consider inclusively and think about how employment is working across the entire segment, many segments of the population, so that rather than just looking at one number, we want to really understand, and really this understanding comes from a recognition that different Americans experience the economy differently throughout even the Southeast. There are so many different economies and different realities, and we wanted to signal that we really understand that. We're going to look at that and incorporate that into our thinking. And then the third point that I think is really important is a statement about how we're thinking about using our tools. And one of the things that came out of our listening sessions was that in growth periods, everyone doesn't get into the economy quite at the same time. And in previous eras, the Fed has been pretty proactive in trying to make sure that the economy doesn't overheat by preventing inflation from becoming a big deal or a big issue. Given the weaker upward pressures on inflation, in our statement, we now are saying that we're going to be comfortable letting interest rates be lower, letting the economy run a bit hotter than we might have otherwise, for two reasons. One, because we don't think that the likelihood of the overheating is nearly as great from an inflation perspective. But two, by doing that, we allow ourselves to reap additional benefits by having people who haven't been so connected to the economy start to get jobs and be more robustly secure in terms of their employment and their economic situation. So those are three really significant changes. And I think we'll see that play out in a very positive way in the next couple of years.
What are you prepared to say about how long we're likely to see the policy rate at zero or effectively at zero?
I don't think I'm prepared to say anything on this. No. What I would say is that it really depends. We've got a lot of stimulus in the economy. We are extremely accommodative right now. We're doing a lot in terms of asset purchases. I think the forward guidance that we're putting out into our statements is also providing a clear signal about where we think about things. And I'd like to get those in a more normalized place before we move our policy rate. All that said, though, I do think there is some possibility that the economy could come back a bit stronger than some are expecting. And if that happens, I'm prepared to support pulling back and recalibrating and a bit of our accommodation, and then considering moving the policy rate. But I don't see that happening in 2021. A whole lot would have to happen for us to get there. And then we'll see into 2022, maybe the second half of 2022, or even 2023, where that might be more in play. But again, all of that is speculation about a lot of other things going certain ways. But I think the most important takeaway that people should have is that we're going to monitor and we're going to do what's appropriate given the information we have at the time. We're not locked into a particular length of time of having any kind of policy stance. We really want to have our policies be informed by what we're seeing on the ground and make adjustments to our policy stance based on that.
As I said a moment ago, the Fed acted very aggressively in March to deal with the rapid onset of the effects of the pandemic. You brought interest rates down to about as low as they can go in terms of the policy rate. You introduced quantitative easing again, the purchases of Treasury and mortgage-backed securities. You put in place some lending programs that were, some of which were unprecedented. And then recently you've strengthened the guidance. Is the Fed out of ammo in the event that something turns badly?
So I don't think so. But before I get too much into that, I did want to say that Chair Powell showed a lot of leadership and a lot of foresight by getting the committee together and really helping us make sure that we positioned our policies in the right way right at the outset. You mentioned all the things that we did. It was bold and it was demonstrably active to say we're going to be out here and we don't want there to be any uncertainty about where the Federal Reserve stands on this. I think that philosophy and that viewpoint, in my mind, is still exactly where we are today. We'll do whatever it is we feel is necessary to support this economy and help it move off of the distress that we've seen through the pandemic. Certainly, we want to stay within the bounds of legality. I tell my staff all the time, I'm not going to jail, so I don't want to have that. But I do want people to know that we continually look at our tools. There are still things that we can do, and we'll deploy them if we believe that they're necessary with every confidence that they will have the desired impact of providing support broadly for the economy.
Let me ask a couple of long-term questions. I think I judge from conversations with people the long-term consequences of some of what we are doing now is on the minds of people. So the consequences of the very high deficit and the growth in the national debt, and sort of the mirror image of that is the growth of the Fed's balance sheet and the so-called money printing that the Fed is doing, again, in unprecedented scale. So how do you think about the long term? And, are you concerned about what this could turn into, a few years hence?
So right now, to be completely honest, my biggest focus is on the short term, because if we get to a situation where that 10 million job deficit is a permanent deficit, not a temporary one, we're going to have pretty significant challenges. And those are things I'd rather avoid. And once we get past that, if we can preserve as much of the economy as we can, we'll be positioned to grow, I think, in a stronger way and start to deal with a number of the issues that you mentioned around the deficit and the debt and our balance sheet. The chair has been very clear on this. I've tried to be as clear as possible on this. These were unprecedented circumstances. As you noted, you didn't ask me any questions about a pandemic a year ago when we were here doing this. And when things are unprecedented, you take unprecedented actions. And then when you move past that space, then you step back from that and then try to get everything else back to that normal. So, I'm committed to not doing emergency things when we're not in emergency times. But we definitely are still in those times. And so I think it's appropriate to continue that engagement. Now, moving forward, the presence and the things that we are taking on because of having to act in an emergency, that will shape the types of things that we do in the future. But I'll deal with that. That's a future problem, and I got present problems that we're trying to wrestle with. I want to get the present problems handled first, and then we'll take care of the future problems. But it's not as if I'm blind to the implications of us having those things. I just think there'll be a better time and a more appropriate time for us to take that on in the future.
We have some questions from the audience, which I want to get to, but one final question. Do you think the COVID experience is going to cause structural change in our economy for the medium to long term?
So that's a really good question, Dennis, and it's one that our team is wrestling with here in our bank. I think the answer is almost certainly yes. When I talk to business leaders across the board and almost in every sector, what they've told, one of the things that they've told me is that the pandemic has forced them to face questions and issues that they had in the back of their mind, but they weren't really sure they were going to take them on, or how important or urgent the issue was. And the pandemic has really created an opportunity for them to look at those a little more seriously and think about it. I think about the healthcare system. Pre-pandemic, there are hospitals in our district that only use telehealth for less than 5% of all of their patient engagements. Now, in some of these systems, it's 30 or 35% of their patient engagements. My guess is that we're not going to go back to 3%. I think there's been learning and experience and a new recognition that can be a viable way to deliver services. And that has implications for how hospitals are going to run pretty much across the board in terms of number of people they need to have on staff, in terms of the amount of space they need to have, and the like. Similarly, when I talk to people in the restaurant industry, some of them have told me that they felt that the sector was it had excess capacity, and that the pandemic is going to lead to a sorting out of firms into those that are going to survive and those that aren't. And that will be a restructuring of the sector that will be important. I think about what we're doing at our bank, which is I got most of my staff now working from home. That wasn't something that was on the agenda, but it's something we're definitely going to have to think about how we integrate that into what we do. So I think there's going to be a lot of structural change. The question to me isn't will there be, it is how much will there be, and in what sectors, and how deeply you'll see that penetration. And that's really the question, or the way we're going to approach this question in the next couple of years.
Great. We have a question from the audience about the nomination of Janet Yellen to be Treasury Secretary, and let me ask you to respond in this context. You have a former Fed chair as Treasury Secretary if she is confirmed, and of course you have Jay Powell, and they know each other very well. They've worked together. They are substantially on the same page on a lot of questions. Is that kind of joined at the hipness likely to risk Fed independence in some way? And what do you think about Janet's nomination? That was the question.
Well, I've known Janet for a long time. She, very early in my career, she gave me some advice about how I should think about progression that has been very helpful. And so I consider her a friend. She's incredibly bright, but also she's got a humanity to her, which makes her incredibly compelling. I'm expecting that she'll do a great job at Treasury. She's done a great job in everything else that she's done, so I don't know why this would be any different. In terms of the relationship with the Fed, I think she is actually going to have, given her background, a heightened sensitivity to this issue about independence of the Fed. And so while her understanding of the Fed will help her have a better sense of what we can do and what that might mean for how Treasury should approach things, I still think there's going to be some independent minds in both the Treasury and the Fed driving policy. So actually don't worry. I don't think we're going to get more politicized because of that relationship, or more linked into the specific congressional policy process or fiscal policy process more broadly.
Mm-hmm. Another question from the audience relates to the extent of fiscal stimulus and fiscal relief. And it sort of touches on this question of independence, because Jay Powell and others have commented on fiscal relief and supported the idea of a fiscal package. So the question is, how much is enough? And do you have do you support the talk of raising it from $600 to $2,000 and so forth?
So what I would say is all the research that I've seen on the relief package and its efficacy suggests that it has been incredibly helpful for us in getting as many families and businesses to a place where they haven't faced ruin. We do a lot of surveys in my bank. All the surveys that we have reached out in terms of businesses have told us that the relief from things like the Paycheck Protection Program have been essential for helping businesses stay afloat. And that's an important thing. Similarly, there was a great prediction that we would have seen a wave of evictions and foreclosures and people not paying on their mortgages. And that by and large has not been realized. And so I think policy has been super important and will continue to be as long as we go through this. All that said, I do think you asked how long. As I said before, we are learning how long. And I think our initial notions of what the time horizon for this whole episode was going to be were tremendously optimistic and have not been realized in practice. And we'll just have to see. I'm hopeful that there remains an openness for us to be recalibrating the length of time that relief is necessary as we learn more about what's happening. And my job is really to make sure the policymakers know what's happening. So we're going to keep engaging with businesses. We're going to keep surveying them to understand what their challenges and opportunities are. We're going to keep engaging with small businesses and communities across the spectrum in terms of affluence and geography. And we're going to tell people what we're seeing and where there is weakness so that those policymakers can make informed decisions about what relief should look like moving forward.
Let me wrap this up then with one more question from the audience, which is kind of a summary question, and that is, in order, as you said earlier, there could be an upside case that develops, and the removal of accommodation and removal of stimulus coming from monetary policy could be earlier rather than later under certain circumstances. What are you watching? What economic data are you watching most in order to make that judgment?
So a couple things that I'm watching. So one is the degree to which job loss is transitioning from temporary to permanent. That is going to be a signal that there is some pretty significant scarring that we have some risk of experiencing. Second is going to be what's happening in terms of small businesses and their ability to take advantage of the relief that's available and remain viable. That'll be a second thing that is particularly important. A third thing that I will be monitoring will be consumer confidence and how are consumers feeling about the economy and their willingness to engage and move forward. But first and foremost on all of them, and I should have said this first, is really the progression of the virus. At its heart, this is a public health problem and challenge, and that's the thing that we need to get under control before we're really going to be able to take a lot of these economic measures and make a lot of sense out of them. So we need that viral progression to slow. We need people to follow public health experts' advice by wearing masks, social distancing, and washing your hands. These are the things that will allow our commerce to operate as close to normal as possible. And these are the things that will help us be as strong as we possibly can be when we get to the other side, so that new recovery that happens super strong and can persist for a long period of time.
Raphael, as always, this has been a great pleasure for me, and I think an excellent interview with lots of great substance for our members. President Cannon, I think it's about time to turn it back to you. So let's call it a wrap, and back to you.
Well, thank you both. Raphael, don't go away yet, and Dennis, don't go away yet. But Dennis, so well organized, and Raphael, this is one of our most exciting, biggest programs, and certainly, once again, you have delivered with thoughtful viewpoints of the future without predicting the future. You guys are really good at doing that. But, just one follow-up question, I had just listening to you, you talk to a lot of CEOs and get their read on, kind of their plans. And there's a lot of cash on the sidelines. Corporate balance sheets generally pretty healthy in some respects with cash. How's their confidence? And when do you see them kind of potentially loosening up on capital spending?
Well, I actually think that they're trying to figure that out right now. My sense is that through the summer and the fall, a lot of the economic recovery, business leaders were grateful for, but they still had questions in their mind as to how solid and how real it was, because there was so much other turmoil and uncertainty in the economy. I think my expectation is as that turmoil and uncertainty starts to resolve itself, as we get closer and closer to the summertime, we're going to start hearing from business leaders that they're ready to make those investments, to use that cash that's on the sidelines to increase the productivity and the production of their enterprises. And that'll be an important turning point for us in really understanding what recovery post-pandemic is going to look like and how quickly we'll get back to that pre-pandemic trajectory.
Well, great. Thank you for that. Helpful. And then maybe just quickly too, when do government deficits matter, or what does history teach us about those deficits? Or is that, still a long-term problem and you're just more focused on the short-term triage?
Well, that's a semester's worth of class to talk about, to be honest. But here's what I would say. I think in our country, one of the most important things is a willingness to support the debt. And we have an advantage because we are viewed as the source of security. And when there's a flight to safety, investors look to the United States. As long as we can preserve and protect that, I think there is an ability for us to support a pretty healthy debt position. That said, we also need to make clear that we have every intention of paying back our debts and fulfilling our obligations, because undermining that is another possible way that things can get far less sustainable and put us under a lot of extra strain. So I think you always have to pay attention to this, but there are countries out there that have a lot less debt than ours that are in far worse position. So the debt by itself, I think just looking at one number is not really sufficient to tell the whole story.
Well, great job answering a semester's worth of class in 1 minute. Well, again, thank you both. One thing I did not get to do was show the results of the Menti poll, and we're actually going to do that now. Well, you guys, I would recommend just stay and listen, because you'll find, what did our club think among really those two questions? What is unemployment expected to be late this year? And how has COVID potentially changed the structure of the economy? So we'll end by looking at that. But I just want to say, Raphael, thank you for joining us today. And Dennis, thank you for leading our discussions today and all month.
Well, thank you, Chair Cannon. And you should have shown this before I got on, because now you're going to tell me I'm out to lunch. So
right.
It's a hard way to end the session.
In the interest of time, normally I do show it before our speakers. In the interest of time, I wanted to go ahead and jump to you guys. So, but now I tell you what, you can come back and rebut and expound based on what we say.